Hello everyone, I'm Miles. Today, we're going to learn by solving problems and uncover the true power of enterprise value, EV, since it's hidden behind two formulas that seem completely different at first glance. Let's start with the most basic balance sheet equation. Assets equal liabilities plus shareholders' equity, or in other words, assets equals liabilities plus equity. Now, let's break it down and look at operating assets. These are the engines that drive a company's profits. Non-operating assets, like cash or short-term investments, aren't part of the core business. Liabilities can also be divided into operating liabilities, such as accounts payable and financing liabilities like debt. To keep things simple, let's assume all non-operating assets are cash, and all non-operating liabilities are debt. After rearranging, we get operating assets minus operating liabilities equals equity plus debt minus cash, which equals enterprise value, EV. Operating assets minus operating liabilities equals equity plus debt minus cash, which equals enterprise value. On the left, we have net operating assets, NOA, the operational perspective of EV. On the right, we have equity plus net debt, the financial perspective of EV. This is the key formula. EV equals NOA. Next, let's use small exercises to apply this conclusion. From the operational perspective, if you raise 200 in equity and spend 100 to buy factories or operating assets, EV increases by 100 because NOA increases by 100. Similarly, if you raise 200 in equity and spend 100 on short-term investments or other non-operating assets, EV and NOA do not change. If you raise 200 in debt and spend 100 to buy factories, EV and NOA increase by 100. If you raise 200 in debt and spend 100 on short-term investments, EV does not change. Why is that? Because only operating assets can increase NOA, and NOA is the real core driver of EV. But in reality, acquirers look at things from a financial perspective. Here, EV is the true cost of acquiring a company. EV equals the market value of common stock plus preferred stock, non-controlling interest, NCI, debt, minus cash, and other non-operating assets. In other words, EV equals market cap of common stock, preferred stock, non-controlling interest, NCI, debt, minus cash, and other non-operating assets. This means all capital providers must be paid. For example, a company's equity includes the market value of common stock, preferred stock, and non-controlling interests. The acquirer will also assume the target company's debt, cash, and other non-operating assets. We only need to calculate net debt is debt minus cash minus non-operating assets. Let's review the same four cases. Raise 200 in financing, invest 100 in equity into a factory EV 100, equity 200, cash 100. Raise 200 in financing, invest 100 in equity into short-term investments. EV remains unchanged. Equity increases by 200, but both cash and non-operating assets increase by 100 each. Raise 200 in financing, invest 100 in debt into a factory. EV increases by 100, debt increases by 200, and cash increases by 100. Raise 200 in financing, invest 100 in debt into short-term investments. EV remains unchanged. Debt increases by 200, but both cash and non-operating assets increase by 100 each. From an operational perspective, EV represents the value of the company's core business engine. From a financial perspective, EV is the real purchase price, the total cost required to acquire the entire company. The key point is when finance meets operations, EV achieves perfect unity. Two perspectives truth. EV is the bridge between how the market prices a company and how companies actually operate. Understand this bridge and you hold the golden key to valuation. In the end, learning finance and accounting is like playing a game. Every time you understand something, it's like leveling up. See you next time.